Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, August the 29th. I got the date right today. My name is Eric Wilkinosn, and some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that I talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, I'm here to teach you some different strategies you can implement in your portfolios, but please do that in your own way. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on with some economic data. Across the pond, we got French consumer spending came in at 0.1%, expected to be 0.3%, but they did revise last month's number up from 0.1% to 0.3%, so pretty much a wash there on that number. And then back here in the United States, we got preliminary GDP coming in at 4.2%, expected to be 4%. That's a catalyst for getting the market to rally here. That would indicate that the Fed is probably going to continue their mandate of increasing interest rates, which should also bring down the bond market. So let's see what happens here in a minute. But we got the prices paid for the GDP came in at 3%, expected to be 3%. Pending home sales came in at negative 0.7%, expected to be a positive 0.3%. So much worse, by a percentage point worse on the new home sales than what was expected. Or pending home sales, I should say, that's any home. Not very good. Anyway, then crude oil inventories coming in a drawdown of 2.6 million barrels, expected to be a drawdown of 0.7 million barrels, so 2 million over expected there, no revisions to last month's number. That would drive crude oil higher. It's some of the highest demand we've seen. We've got huge production going on, but we're still seeing a drawdown. So drawdowns indicates demand, and we are at historical production here in the United States. That leads one to believe that there is massive demand for crude oil right now. That is a catalyst for growing economy, indicator anyway. With crude oil up about 79 cents, it did pierce above the 50 Fibonacci we've been talking about. It's right near the point of control. It's going to have a tough time getting through this level. But once it does, then that should give it a little bit more room to the upside. I'm still in the camp that anything much above 70 is really going to start getting the economy to pull back a little bit because of spending, crimping on spending. I'd much rather see oil roll over, increase productivity, get oil down so that velocity of money can continue in the United States, because if we all are spending money on one product, that doesn't create velocity of money. But having said that, crude oil, high demand, should drive it a little bit higher. Gold futures trying to claw some of the losses back yesterday. Big downturn in gold yesterday. Today trying to claw it back with it being able to stay above 1200 right now, which is obviously what the bulls want. I've been talking about that for days. I think that 1200 psychological level is a major support level that the bulls are going to defend. Now, Bitcoin giving up a little bit of distance from yesterday. Yesterday had a big rally along with like gold and some of the other commodities like that that would be associated with that kind of demand. But giving back a little bit today, but not a whole lot of volume going on there. Bonds, this is what I was talking about. With all this demand, GDP, everything else moving higher, that's got to be an indicator to the bonds that, hey, the Fed is going to continue to increase interest rates. They aren't going to lower them, despite the fact that there's global demand for our bonds. And that's really this levers and pulleys we're seeing going on here, is that people are willing to give up a little bit of edge across the pond and in Europe, other nations, because even in Venezuela, let's say, because their bonds are garbage and they need to park their money somewhere, so they're willing to lose a little bit over here rather than lose a lot over here where they have their current money. So that's driving bonds higher and getting it a little overdone, a little overzealous to the upside. We're seeing that continue to roll over now, as the mandate would be expected to continue to increase interest rates with these GDP numbers. All right, so bonds moving lower on the day. VIX unchanged for the most part, despite the fact that all of our charts have gotten blown out of the water. Yesterday we were looking at this doji, maybe that was creating a topping pattern. When we see that pattern at the top of a move, that is usually a pretty bearish signal. And I told you yesterday I was going to wait to see how this all was going to shake out, if we were going to get confirmation to the downside or if a rally to the upside would break that. Now, even a sell-off all the way back down to unchanged at this point in, especially NASDAQ, and we'll see it show up in like the Dow and the mini S&Ps, even a sell-off back down at this point is going to make this chart look like a continuing pattern, because we'll have those two counter-opposing doji. Right now we have a hangman doji, it'd be a spinning top doji, and those are a continuation pattern. So at this point, it looks like green light to the upside, at least for the shorter duration, next week, I would say. We are looking like we are going to be moving higher and maybe start pushing up against this trend channel bottom here. So that would be where I think we're going to migrate to. As a matter of fact, the 78 Fibonacci almost seems like a foregone conclusion at this point. So if you're playing anything to the upside, that's the line in the sand I would be looking for. And I'll talk about my SPY trade that I put on today here in a minute, kind of correlating to that. Similar with E-mini S&Ps here, we've got the market moving higher, breaking that pattern there. I don't see where my Dow Jones went to, but it will look like a very similar pattern. Did I already go over the Dow Jones breaking above the value area high, breaking this chart pattern here? Looks like we're going to go up to the 50 Fibonacci extension, which correlates to, what is that, 26,748 or 478. Sorry, eyes are a little blurry this morning, I guess. But that seems to be where I think the market is wanting to head to for the Dow. E-mini S&Ps, that's going to correlate to right here at around, I can't remember what I thought it was, 2970 something, 2975. That's where I think the E-mini S&P is going to go. Now that we're piercing above that, broke that chain, it seems like a foregone conclusion to the upside there as well. Let's look at the E-mini S&Ps on the daily chart. Nothing to see yesterday. It was just a blah day, to be quite honest. Today, coming into the opening session, got a little bit long, flushed out, heading into the morning open, and then on the morning's open after the economic data points. The only one that was a wet blank was maybe those pending home sales. That's probably due to increased interest rates, and people are holding off, trying to wait for interest rates to come back down. Don't think that's going to happen. So that being said, that was really the only one that didn't look too bad, or that looked not too good, I should say. So unabated to the upside, no red candles on a 30-minute chart is very bullish at this point in the day. So let's look at a trade that I've done with this break of the chart pattern here. No attempt to cover this gap here. Remember, the ETFs don't trade overnight, so you're going to see a little bit more gaps, but the market does like to cover those no matter what during the intraday session. See, these prices have never traded during the day session ever. So that is going to be something the market has in the back of its mind and is going to want to come back and retrace. So the way I kind of am looking at this right now is the market's going to want to trend a little bit higher for maybe the next week or week and a half, 2 weeks. Then we're going to come back down, tag this Fibonacci level, cover that gap, and then maybe continue the rally. But it's going to want to cover that gap sometime in the near future before it can really feel like it can rally. Because, when you see gaps inside of like moves here, maybe like a gap here or something like that, and the market rallies and wants to cover that gap, it's not nearly as strong as a price that has never traded. Okay, so keep that in mind. It has never traded. It's going to want to trade there. I'm still playing this to the upside with my SPY trade that I put on today. I went into the November to get that long duration, so I don't have to worry about theta decay as much because implied volatility is super low, as you can tell here. I'm expecting volatility to expand, so I am looking to buy options. And with a downward bias, I would be buying puts, but because I have an upward bias for at least the next couple of weeks, I'm looking at the November and bought the 395 calls for $3.92. Now, why did I buy those $3.95 calls? Because if we squeeze this down just a little bit, you can see that on the SPY, not on this chart, but if I pull up the Fibonacci extensions, let's just see if I can pull this up real quick because it's not on this chart. I want to go to extensions quickly while you're trying to think and talk at the same time. Let's just see if I can pull this off with the Fibonacci extension real quick. Shooting from the hip is not working very well. But the Fibonacci extension, believe it or not, puts me at 296. That's where the extension lands there, correlating to the SPY, to the E-mini S&Ps. You saw that extension there. It's not on this chart here, but maybe I can pull it up over here. Here we go. Let's just use this chart. I'm not sure why it's not showing up on the other one, but as you can see, the extension here takes me up to right there at 296. That's the one that has the extension that I was talking about, using this as the pullback. It's been very solid, so I think that that's where we are going to ultimately go to for the SPY. That's why I picked that strike. All right, so hopefully that'll work out. We'll go up, tag that. I can get out of that trade. We get that retracement back down, cover that gap. Everything works out just the way we planned and wrote it up on a piece of paper, right? We'll have to see about that, so follow me on this market commentary until we see what happens, and if I have to stay mechanical with it, I will. I'll talk about it if it goes against me and what I'm doing to counter attack that. All right, so follow me on Twitter at Wolfman's blog. Check out ProTraderStrategies.com for the upcoming webinar, because it is all about defending these kind of strategies. All the strategies I've talked about. We've taught all of these strategies. Now we're going to talk a little about how to defend some of these strategies in Friday's webinar, how to stay mechanical. That's how you're going to increase your probabilities, all right? So very important webinar to check out. Go to ProTrader Strategies and sign up for that. If you can't take that, take it easy.